All right. Welcome, everyone. This is a Fireside Chat. Glad to have everyone with us. Mike Beatty, Director of Startup Grind. We also co-sponsor these events with Maureen from Metro Cowork. So a great co-working space here in Rochester. Thanks for all your support on these events, Maureen and team. Today, we've got an awesome guest host and guest speaker for Fireside Chat. We're joined here today with Patrick Bosek, who's one of the founders of what was Jorsec and was getting rebranded, and we'll go into that a little bit. Steve Hovagimyan.
Very good.
Close
enough.
I was better than their practice round. The Director of Investment Origination and Business Development from Armory Square Ventures. So Steve's going to help us out with leading the Q&A with Patrick today. And again, thanks everyone for joining. I'll ask everyone, feel free to, put in, we'll use the general chat if everyone's all right with that throughout the presentation today. We'll monitor as we go. From there, I'll hand it over to Steve and Patrick. Thanks, guys.
Cool. Great. Thanks, Michael. Really excited to be here. Thanks everybody for giving us some of your time today. Just a little bit more background. Like Mike said, I'm a director at Armory Square Ventures, based in Syracuse and New York City. I focus on deal sourcing, leading those efforts and coaching others on the team. I also act as an advisor to other VC-backed companies in CFO type matters. And I've bounced back and forth between venture capital and operating. So I've been fortunate to see both sides of the table. A little bit on ASV, we're an early stage investor, and what that means to me, because the definitions keep shifting like Patrick and I and Michael were just talking about. We define early stage as post-product, post-revenue. There's evidence of an early market fit. We focus on B2B SaaS companies, now especially ones that leverage all these great cities in the US that are often overlooked by most of the VC industry. Right, but especially the cities that have these essential elements that we learned decades ago are important, like a high quality, highly educated workforce, great educational institutions, and mostly, in addition to that, an attractive cost and quality of living for workers. We feel that these are the seeds for some great new tech ecosystems. So you can see why we're really excited about cities like Buffalo, Syracuse, and of course Rochester, and why we're excited about gritty, smart, gritty and smart entrepreneurs like Patrick Bosek.
Oh, that's my cue. Okay, cool.
And that'll be your cue.
Okay. Well, I'm Patrick Bosek, and I'm from one of those great cities, Rochester. I am the CEO of Jorsec Inc., and now publicly we're known as Heretto, which is also our product. We produce a content operation system that's primarily for knowledge content and knowledge management. So what our system does is it makes the process of maintaining product reference and knowledge content like an order of magnitude more scalable, and gives you a headless API first services layer for delivering it wherever it needs to go. So that can be really high quality experiences like help sites. It can be into more specific experiences like chatbots. It can be into hard copy like PDF. And it can be all of these things in all the languages and for different filtrations and variations for different audiences. So if you're an organization that has a bunch of different variations of a product in a bunch of different languages and a bunch of different users that use it in different ways, our system can automatically generate content for those individuals and situations and make your life a lot easier and less expensive. We have a team that's been based in Rochester for quite a while. We've been working with Armory Square Ventures for the last almost 2 years. We're getting pretty close.
Yep.
Yeah, it's really a pleasure to be here and it's always fun to talk to you, Steve. It's fun to do it publicly, so I'm excited about having this chat.
Appreciate it. Yeah, no, me too. Mike did a great job in sending out the invite and describing, the situation for startups and founders, which is, this is a real important part of the process, capital raising. And it's probably very stressful. When is the right time to do it? Who are the right people to work with? And I'm going to quote Mike's intro where it says, investing equity in a new venture means there's going to be a very long relationship between the founders and the VCs. Before I go into how you found the right venture capital investor, how did you come to the decision to raise capital? And I know you did it a little bit later in your company's evolution, which may be different than a lot of people's experience, right? So maybe tell everybody, how did you finally come to the decision to raise capital, and did you toy with it, with the idea over like the first how many ever years you were in business?
Sure. So I think that it's really important to kind of set the table a little bit with like who we were at the time and our perspective on it. There's a lot of different organizations that will go for capital that are in different situations. I think our situation is maybe a little more common to some of these great but sometimes forgotten cities like Rochester, Buffalo, and Syracuse. And that is that, we were an organization that was not, we were still very small by most metrics, but we were over 7 figures in revenue, and that was all recurring revenue. We had a team in place. We kind of had product market fit, and we were growing. So we were kind of like break even on an annual basis. At least that was the target. But one year we'd be a little profitable, 1 year we'd be a little under. So averaged out to break even. But we were kind of growing at like a, call it 20-25% rate. And I think the thing is, when you're in that particular situation where we were, and you're kind of a well-established, stable business, you're profitable. The decision to go and raise venture capital is really a decision around like, can you go faster in a meaningful way? So it's really an ROI decision. And what you're doing when you take on venture capital as a B2B software company is you're really just taking on resources so you can hire ahead of revenue. Like that's the whole thing. Like if you really, really break it all down, because you're not a capital company, you're not going out and buying equipment. It's not like we've got 100 orders for 1,000 pounds of ice cream or something, and we can't fulfill them because we don't have the machines. It's just not like that, right? So it's really like, okay, if we have more people doing more key things in the business, is that going to allow us to accelerate our growth rate in a meaningful way that is above the quantity? It offsets the capital that you're taking in, the dilution that you take, right? Frankly, right? So as a founder, you really sit there and you go, all right, well, my piece is probably worth this right now. And if I take venture capital on, like theoretically it's worth the same amount, but like, that's not necessarily always the same in practice when you actually would go to be acquired or sell or something like that. If I take this venture capital on and I operationalize this money, am I going to be able to grow the valuation in such a way where it's going to benefit me and the other owners in the end? It's really just a kind of a calculation, frankly.
Cool. Yeah. No, I'm familiar with that. So I'm curious, as you bring it up, some people might be wondering, well, like, wow, that's cool. You got to $1 million and then you could raise venture, but how did you fund the business from the get-go?
So we have kind of a funny story, and I wouldn't recommend anybody does it this way, but I will tell you how we did it. So my co-founder and I actually came out of the RIT incubator space, and we more or less lived in a box about the size of the office I'm sitting in right now, like building the first version of the software and also selling it. And we were relatively unsuccessful there. But then after a few 5 years of this almost, we kind of found our way into a niche that was a little more successful. And just through basic networking, we happened to come across a few people who acted as kind of guides into this niche for us. And then we kind of got our first real experience with product market fit. And we actually closed a couple of customers. And from there, we raised a small angel round that let us really get the legal framework and some of the other like basic business infrastructure into place so that we can continue to scale. And we kind of went from there. So it was like really like a grinded out type of a situation. But like one of the things about that is that in today's world, I don't know that grinded out always works. Like you have to really think about market conditions, because like if you started a business in our space now and you were like, okay, we're going to grind it out for however long before we can actually have a product, like, you know, right, the world has gone, has moved.
Yeah.
It's no longer where you need it to be. So there's really always like a very much like a time and place aspect to the calculation as to how you're going to devote resources to something.
Yep.
And so I think that that's part of the reason that our situation was a little bit unique.
Yeah, that's fair. I mean, we do when we're looking at deals, right? One of the questions is why now, right?
Oh, totally.
And
yeah, like sometimes why now really is like, why not in 3 years? Like if you really look, like one of the things that was both good and bad for us, it's that our initial thesis on this market has turned out to be true, but it turned out to be true like 8 years later than we thought it was going to be true.
Right.
So, I mean, like,
yeah,
we got a free 8 years, if you want to call it that, to like build and develop and all those kinds of things. But at the same time, like, had we taken capital back then, we never would have been successful. It would have been impossible.
Quick question: how much in angel money did you find? Or did you take on, and you know, where did you find it? Did you find it through the accelerator? You know, industry contacts.
It was through industry contacts, and it was low six figures. So it wasn't a ton of money. And we honestly, like, you know, I want to say that we were pretty smart in how we spent it, but we spent a lot of it really just establishing the business and legal framework for the company, and like allowing ourselves to do business, like getting insurance into place, like getting like all that like really, really boring stuff. And then we obviously like we took a very small amount of salary, but you can't take much of a salary on 6 figures of angel money. So
yeah.
But
then you also don't have to give up as much equity, and you start playing that ROI mental calculation you were talking about.
Totally.
Now you fast forward to the $1 million run rate, or not run rate, but the $1 million 7-figure revenue number. You decide, you know, did you say, okay, we're now going to raise capital, or, you know, how did that transpire? Did you talk to several different investors, or, you know, what was that process about?
So in our case, it kind of was a couple of things. We came to a point where we realized that we had what was going to continue to be a pretty successful lifestyle business, and we could stay there, right? We could kind of stay like very tight in this little tiny niche that we had, and that would be okay, but it wasn't going to be like the roller coaster rocket ship that we really wanted. It didn't match our ambitions. And so there was a personal aspect to it. And I'm bringing that up because like, I think that sometimes it's almost frowned upon to talk about like how, you know, there's personal ambitions as a part of the venture capital decision. And I mean, there's professional stuff too that I'm going to talk about in a second, but I do think that it's really important to step back and think, okay, this is a real phase shift. And does it align with my personal decisions, personal ambitions, and personal outlook on how I want my life to look for X number of years, right? And so my business partner, Casey, and I, we sat down and we basically said, we think a high growth venture is more in line with what we want to be doing and how we want to be spending our time and how we want to be running our business and enjoying our lives, right? So I think that's the first checkbox. And I think if you skip that, you can make a really big mistake, because there's a lot of stuff that comes with venture capital, and it's not just business. Because when you're this deeply into a business, it's your life, right? Like it's a really big part of your life. So you kind of put a checkbox there, and we did that. You know, we had those conversations, and they weren't simple conversations. On the business side of things, we decided it was kind of, so we had done that a little bit before we actually decided to like really earnest go out and look for money. We kind of like wavered on like when the right moment to take money was for a little while. And I started kind of just going out and talking to people and, you know, seeing like what the perspective was, like what the valuations were going to look like. And I think that period, we weren't serious about it, right? It was really intel gathering. But I think that's an important part of the story as well, because that was probably like 8 months that we were really, we weren't pitching, we were kind of having conversations. And then there was a point there where we kind of said, okay, we think that knowledge management is coming up on another wave and another replacement cycle. And we think that this market, we think the approach to this market is going to shift, and it's going to shift in our direction. And I think that's one of the key things that you can look at when you're deciding whether or not, you're right for venture capital, is it's not always, there's always things like AI, right? Like, we're an AI company. Yay, AI is a big wave, blah, 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 blah. And like, I'm not going to I have my opinions on AI companies. I'm not gonna now.
And I'm a sucker for them. Yeah.
Right. So anyways, but the thing is but one of the other things you can look at is you can say, so this is a relatively large established market, but the way it's doing things, the center of gravity is shifting. And if it's shifting towards you, that can be white space too. And we kind of thought that that's where things were going. And I think we're being proven right about that now. I think it's actually taken maybe a year longer than we thought it was going to be. I think we were ahead a little bit, but we're really starting to see that shift happen now. Like, there's a lot of the things that we've been talking about for a long time that are coming into the common lexicon. So we really feel like we made the right decision there. And with that shift in that marketplace towards, our methodology, our technology set, our approach to things, we really feel like that's an opportunity to take advantage of that shift and to grow very, very quickly, and therefore really rewrite the way that people operate inside of this job role, marketplace, whatever you want to call it.
Yeah. So you touched on something I think is really interesting. And you said something about venture capital comes with things, right? And so, like, I often talk about, and I think it's really interesting and important to make sure, and maybe this is what you're talking about, alignment, right? Kind of alignment of goals between the founder and the VC, and as much personal as professional, right? Because I don't want to invest in a company, in your company, and then make you do something you're not comfortable with, because neither of us are going to be happy, right?
Right.
I do think it's important the founder and the VC to agree, like, okay, this is like the joint goals, right? We want to build $1 billion company. Like, we're not in this to build a $20 million company. And that's cool, right? There's believe me, there's nothing wrong with a $20 million company at all.
Right.
It's kind of not what VCs get paid to do. Other people, or at least not a lot of the VCs, get paid to do. There are probably some investors and angels that are fine with that. But you're right, I think it's important to make sure that you guys agree. So did you experience that?
Sure. So there's, this is one of the things that I think is most interesting about this, that I think is most opaque from the outside. And there was a really interesting tweet recently that I want to say either Somac or Pia actually liked. And it was talking about how many of the unicorns, so startups worth over $1 billion, actually have $100 million in revenue. So a 10x on revenue, right? And it's gone down significantly. A lot of them don't. Whereas it used to be that was the line. You had to have at least, your valuation wasn't going to be more than 10x revenue, right? Some really, really fast growing hot stuff might be 12.
Yeah.
And it's interesting that you say that, because you say $1 billion business, but what do you mean, right? Do you mean $1 billion in valuation, or do you mean $1 billion in revenue? Because those are two very, very different businesses.
Great.
And one of the things that I discovered as I was going through my just talk to whoever would talk to me phase is that different VCs looked at that really differently, really, really differently. And I figured out pretty quickly that I wasn't comfortable with the venture capitalists that would assign a really large valuation to our organization, because I just didn't feel like it was in line with kind of the market conditions, with the style of organization we were, the go-to-market strategy, all those kinds of things, because it wasn't something where we were going to be on stage at SaaStr talking about, the new AI module, being put into Microsoft, which isn't bad, right? Like our company is in an enormous market. Like there's some estimates that put it at $100 billion, right? And growing at like a 20% rate over the next X number of years. So it's a really big market. So there's nothing saying that. I mean, it's entirely plausible that our company can get to the point where we're over $100 million in revenue, and at that point in time, we could be worth $1 billion. But there might also be some Uber competitor who's only doing maybe they're transacting on $100 million, but their actual revenue at the end of the day, because their margins on that is like 10 million, right? And they have the same valuation. So I think that when you get into what's the alignment, I think the type of business that the VC understands and likes from how you go to market, how you make money, how you service customers, how you deal with, things in the P&L, right? Like the P&L will tell you the valuable parts of your business or the levers of your business. If you don't have a similar thought process on how those financial mechanisms in your business should work with your venture capitalists, you're not going to be on the same page, and that's going to be a problem. So I know that was a really complicated answer to your question, but I think that those things really do matter.
No, I think you're right in terms of it being opaque too, and people not understanding, because of course, we'll hear it a lot, like, oh, you're a B2B SaaS investor. I'm a B2B SaaS company. Write a check.
Right.
Okay, hold up. That's cool. That gets us to kind of a first date, but there's just like we said, this is an analogy for long relationships, right? There's a lot more to determine whether you really want to be in a relationship with me. I'm always it's not you, it's me. Right? But do you want to be in a relationship with me? Because this is my expectation.
I don't think that's a nice thing to say in venture capital. I think that might be a nice thing in dating, but people assume that it's not them, it's you in venture capital.
Good point. So I'm trying to change that, but now you totally threw me off the track. No, so you were talking about valuation, and people were throwing valuations you weren't comfortable with. Are you talking about, or were you talking about valuations at which they wanted to invest in that time, or valuations that they expected to reach at the end of the journey?
Well, pre-money valuations,
Gotcha.
where we
were. Great. So this is a great conversation, and kind of they're both very important, right?
Mm-hmm.
So yeah, I think that's a little rarer with entrepreneurs because everyone gets fooled by the whole vanity metric of current valuation. Right. And there are pitfalls for sure. Like it feels great to have somebody come in and say, we think your company's worth $50 million and you don't even have revenue yet, or you have $1 of revenue.
Right.
What scared you about that?
So scared is the wrong word. It didn't scare me.
What gave you pause?
So what gave me pause is that I'm outcome focused. And I know that if I start at a certain valuation, I needed to achieve a set of outcomes that were going to be unrealistic for how fast our company could go. And it's not just about money. Any company can burn money. That's not that hard, right?
Yeah.
But there are, if you really know your business, where the stress points in it are. It's just like building an aircraft, right? So if you have an aircraft with, fixed straight wings, you can't put a jet engine on that aircraft and expect it to fly. The wings are going to rip off, right?
Yep.
So what you have to do is you have to go out and get the best, most efficient, fastest propeller, and then you have to go and build swept wings and replace them before you put the jet engine on. It's kind of this process of knowing what the upgrade cycle in your business is going to be. And in that process, the best thing that you can do, in my opinion anyways, is you can do things which are aggressive and ambitious, but they meet expectation, right? Because the worst thing in the world is if you set expectations way too high and you miss them by a ton, and then you're screwed, right? I don't have any desire to go out of business. Our business is a legitimate business. It's not, Like, it's not just, I've got some, dog walking, whatever, like concept. Like, it's not like a fly by night thing, right? So I'm not just taking one big swing. Like my approach to this is to swing as hard as I can, but build a game plan to win the game on doubles and singles, and every once in a while hit a home run. Like, I'm not banking on hitting home runs every time. And I think that's where you end up when you take too high of a valuation. You want a steady climb. You want stairs, right? To get you to your final goal.
Yeah, I just saw a question come in, but I'm gonna hold off on that for a second, just because I want to finish this topic about aligning expectations. And one thing to add to what Patrick said too is that I find a lot of founders make mistakes, and I don't know if you went through it. I doubt it, because I knowing you, you didn't. But a lot of founders will just kind of scatter spray to VCs, and so I'll get a lot of plans for B2C, whereas we pretty clearly state we're B2B SaaS. Once in a rare while we may stray a little bit. Then there's other people who, say they're hardware investors and, get a software plan, or I'm a software investor and I get a hardware plan. Did you go through any of that at all, or, agree that that's kind of a bad strategy for founders?
So when you started this by saying, I don't know if you've gone through this, I figured the answer was going to be yes, because I feel like I've stubbed my toe on every freaking rock and on the way. But this actually isn't one that I stubbed my toe on. So I still take probably 3 to 4, maybe 5 at the most, kind of cold calls a week from potential future capital partners. But when I get on these calls, I would say only about a third of them do I ever actually try to convince them that we're potentially a good fit. Potentially. Like, I start and I just grill them on their fund. And this is after I've read through their website. Like, I don't even respond to the email until I read the website and I find something that I think aligns with how I think about business, right?
Really smart.
I go and I look and I see, like, have they invested in things that are similar? Do they seem to have a portfolio? Yada, yada, yada. And then, when I get on these calls, like, I only want to be on a call that's valuable, and I want to be on calls that aren't valuable for the smallest amount of time possible, because, like, I have other things to go do. And frankly, so do they. I generally speaking will give them like 3 to 5 minutes at the most to like do their pitch. If their pitch starts to go into like, we're not just money, I'll be like, okay, let's talk about that later. Like, because like they all have we're not just money. And I mean, you guys are awesome. I love you guys. And like, it turns out that Somac and our Armory actually aren't just money. You guys have been awesome. And I can talk about why that is in a minute. But for the most part, like, especially when you're getting past kind of that first VC that like gets you into the game and like believes in you, which is what Somac and Armory have been for us. They're kind of just money. I mean, they're not just money, but like kind of like that's the primary thing, right?
Yeah.
So, but then I kind of go through a list of things where like, I want to know what fund you're on. Are you in fund 1 or fund 10? How big is your fund? How many investments how many checks do you write out of that? How much do you reserve for follow-on? What's your period on your fund? Your funds overlap. What are the growth targets you look for? What are the conditions that you invest in? What is your tolerance for burn? What are the attributes are you looking for? Like, how do you feel about capital efficiency? Like, what other KPIs do you look for? Like, do you really dig into net dollar retention? Do you look at net promoter score? Like, what other things are you, and like, I just have a list of these things that like, I just go down through and like, I grill them. And it's funny because usually these guys are like associates at these firms and they're like, and if their answers aren't right, I will stop the call at like 10, 12 minutes. I'll just say, I don't think we're a fit. I think it should go even a step further than, are you B2B, whatever, like whatever your business model is. There's a lot of attributes where like, if let's say you're an organization and you're a platform technology, and you're not highly capital efficient, you have a fairly high burn, but your growth rate is also like it's pretty darn good. Let's say it's high double digits or maybe low triple digits. If you get on the phone with a capital provider that doesn't like businesses that aren't capital efficient, and you go, like, one of the questions I'll ask them is like, what is the median growth rate for organizations in your portfolio like us? And they tell you like, oh, well, we're okay with burn, but like we like capital efficient businesses, and like our median growth rate is like 65%. You could be like, okay, well then how are we a fit, right? So it can be even as detailed as that. So like know your business and then know what the organization likes to build around, because private equity, growth equity, venture capital, like blah, 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 blah. And then all the different phases, they all have different criteria that they look at these things. And you have to align that with your outcome and your business objectives.
Yeah, I think you're equipped to ask those kind of questions, maybe more so than a lot of founders, maybe even a lot that are listening today, because you did some of that intel gathering that you were talking about early, right? Where you call people, or not call people, but you ask around and kind of understand the landscape and try to understand the audience that you will be talking to. You think that's good advice for people? Or do you think I'm right? Yeah.
Well, so I think, so this is how I look at this. And if I was going to pick a mistake that I made early on, probably pre and post funding to some extent, that is one of the biggest things I would tell people to not follow my footsteps on. There's a list, but this is probably the top of it. Is that I didn't understand my job. And the reality is that I came from a product background, and then I went through a long period of being the primary salesperson for the organization. Now, there is no doubt that my job still involves a lot of sales, and it involves some product. Like those are aspects of my job. But if you look at like my job responsibilities, which I have a list of, the first one is to keep the business capitalized.
Yeah.
Right? That's my job, right? And the thing to say about that that's really important is that your business runs on revenue, so somebody else better have their first bullet as revenue. And if you're an outbound style organization, if your go-to-market strategy is built around outbound, you must have a sales leader. Like you must have a sales leader. They must align with you. They must understand and appreciate and know how to execute your go-to-market strategy, like inside of the parameters of your business. And they must be somebody that will leverage you properly. And because of the fact that we had kind of been like inbound-ish, but really, we had kind of just grown organically, I didn't really have my head wrapped around that day one. And that was the thing that slowed us down probably the most, is that I didn't, and then we went out and we hired a sales leader. Like we did that. But
were you both product, or both you and Casey when you started it? Were you both product people? Or?
Yeah. We were both product when we started. And then I gravitated over towards the sales stuff.
Yeah.
And Casey's actually a very good salesman too. I don't know how that split got determined. It turned out that way.
It just happens.
Yeah, it just happens.
So, you were talking about they in terms of VCs, and I wanted to remind you that I was in the room when you were saying that. Hello. But, it was funny, and you were nice saying that we added a lot of, or that we do a lot of help, but I guess my question is sort of around value add for the people here. Like maybe specifically, in what ways have we helped you? And I just want to remind the audience, like, so I wasn't working with Armory when they made the investment. You hear Patrick referring to Somac. Somac is the founder of ASV, who I actually happened to hire into venture like 100 years ago. So we've worked together closely, but I wasn't here to do the investment with Patrick. So he's the one who's added any value that Patrick might describe right now.
100 years ago. We both have aged very well.
Yeah.
So there's a couple of things that I've very consistently been pitched on as things that capital providers will help you with, that I have found pretty consistently they don't, which are like any kind of recruiting, any kind of like sales introductions, any kind of like any of that kind of stuff. And there also is an aspect of like assistance with strategy that one I found to be true in some circumstances, but not other circumstances. And I think that like that's really important. Where I've consistently found the people we've worked with and SOMAC in droves is connections to capital, right?
Mm-hmm.
And, you know, I think that like, I don't know why capital providers really are trying to do this whole, like, we're not just capital thing. Like, capital is the thing that lets you do your job, right? Like, why can't you just be the thing, right? Like, that is the thing that, and SOMAC, you know, put us into the ecosystem. You know, he opened the doors for us. And being an upstate organization, like, I don't care or need or necessarily want SOMAC to help me, you know, hiring or finding customers. Like, he got us into like the funding world. Like, how valuable, that's so much more valuable. You don't need to be any more than that, right? So like when I say that like capital providers are capital providers, I don't mean that in like a, you know, it's like it's a bad thing. Like, it's just true. Like, that's your jobs. Like, you're good at it. Like, just do your jobs.
Yeah.
Now that said, SOMAC has also helped us interview leadership positions, and he has been a phenomenal gut check and sounding board for those types of things. He's also helped when we've been having to make some key strategic decisions, mostly related to capital and finances again.
Sure.
But like, you know, SOMAC has been really just an incredible, like, trusted advisor for me. Like, he's someone that I can call and I can really get an unadulterated and like really fair perspective from. So, you know, I do think that SOMAC has provided a level of advisory and counseling and those types of things, which he should, because he's on our board. You know, like, if they're on the board, that's a different story too. They've got more time to spend with you. Whereas, you know, some of our other capital providers, like, they're not really on the board, and like they're just, you know, they've helped us with capital. They've made some introductions, and that's been really good. They've opened their networks up, but they're not going to get in and like help you with sales strategy.
Yeah.
Like, they're not going to run your business. They're not going to teach you how to run your business. And some of them will tell you that they do, but
yeah,
I mean, it's your business, right?
That's a good point. Like, and look, we're typically lead investors, right? Yep. So the bar for value add, if you will, the bar for value add is a little higher for the person who's leading your deal. Like, right, they're leading the deal,
right?
Leading the event, they should contribute more. But I think you're right. Like, as you're talking to followers, it's probably not a bad idea to kind of dig into them a little bit and see what kind of value they'll bring in addition to the money, right? If you have your choice of cash, then at least see if they have some network that they can bring. If they have a portfolio, the one thing as you were talking about that, I think that's really useful is if you have an investor who has, you know, 10 or 20 companies that are like you.
Yeah.
You can always, because it gets kind of lonely being an operator. It surely gets lonely being the founder of a company sometimes. You know, it's helpful to go out and say, okay, what accounting systems do you guys use?
Yeah.
You know, partial to that side of the business. But, you know, do you have people that are using Jira for tickets? Whatever.
Right.
I mean, what's a good price for Jira? Like, I think these guys are trying to jam us. Stupid stuff like that,
right,
you know, can be helpful, I think. But
yeah, it can be. And like, so introductions to other founders in the network can be really, really valuable. So like connectors can be really valuable. And one of our other capital partners, Graycroft, they've actually been really good about that. They've made some good connections for us. But you have to be active in that stuff. You know, it's not like they don't like call you up and be like, hey, I've got a connection for you. It's like you got to like go and like do your research, those kinds of things. So, you know, I think that like in some ways you kind of get out what you ask for in those conditions, especially I think at the lower quantities of money, right? Where like, if a firm has come and put a ton of money into your portfolio and they've got one of their partners on your board and like, you know, you're one of like the key organizations in their portfolio, they're probably going to be able to invest more time in you because they put more money in you, right?
Yeah.
But like at the phase where you're kind of where we were, I guess maybe still are to some extent, I just think it's important to drive home that like, you got to make your business successful. Like capital providers give you fuel, and like they'll make some connections, they'll provide some advice, and like if you're lucky to find a SOMAC, you'll get a lot of like wisdom that comes with it and all those kinds of things. But I just think that like you should never get to the point where you think that that whatever is being told to you in the process of pitching, that they're going to make your business successful, because they're not. Like you have to do that.
Yeah. True. So, we have 15 minutes left, and we got a question. So I wanted to just kind of jump over to that, if that's okay.
Yeah.
And so it's a little off the investing path, but it's pretty important, because it's one of the linchpins, I think, to raising capital, especially from ASV. The question is, what do you think is the key to finding product market fit?
Well, I think you can go into this in a couple of different ways.
Yeah.
So, I recently was chatting with a founder who is pre-product, pre-revenue, and like he just already knows the market. I mean, like it's like, and he can describe it to you, and you're like, oh, okay, yeah, all right, duh, right? Yeah. So it's one of those things where sometimes you're aware of a problem and you can't find a solution. And like, if you're aware of a problem that has a reasonable amount of people that have it, and you're like really in that infancy stage, like, pre-product market fit or whatever you want to call it. I think if you cannot find a solution after a few hours of Googling, you can be fairly sure that like, either this is a problem people haven't recognized, and like maybe you've got an opportunity to go into a white space, at which point like product market fit is probably finding product market fit in that circumstance is a process of going and just like talking to people and seeing if there's interest. And that's not really product market fit. That's like product market interest maybe. Yeah. And I think that's where a lot of people start. If you are somebody who kind of is more on the technology side of things, and you've kind of invented something that you think could be really useful in some like kind of not some way, but like some way inside of a certain set of parameters, which is where we were coming from, right? Like, so we invented some really interesting technology around structured content in XML, like way back when. And we looked out in the market and we saw a lot of people selling XML solutions, right? And we were like, okay, well, we do X, Y, and Z better than these guys. Like, there's probably a market here. At that point in time, you're in a different circumstance. And then you really have to go out, and I think you really have to have some people buy your product. Like, I think that like, you've got to find some people to actually buy it. And these people are probably not going to have their problems really solved by your first solution, because like, they're the early adopters, and it's probably not exactly what they need. And then you basically just sit with them, right?
Yeah.
Until they're really happy with it. And once they're really happy with it, hopefully you've done your research and you are aware of the fact that there are a lot more people like them. And then you go to see if you can find, 10 more. Yeah. I think like once you kind of get to that point where you have 10 or 20 or 30, depending on the ticket price for your product, right? Like, your product costs $1 million and you've got 10 customers, you're doing great. But like, if you're kind of like enterprise software, so you're somewhere in the 5 figures to 6 figures, once you're in there and like you've got 10 or 20 or 30 customers and they're all kind of using it the same way, they all kind of like respond to it the same way, they all kind of complain about it the same way. Yeah. And you know how to get to the next ones, then I think you're in a place where you can start to proclaim that you have some product market fit.
Yeah, I think you're right. That's what we talk about, being sort of like you get to the point where you've got a rinse repeat process, right? So you've got this recipe for success that you could do that you've done 20 times. Now you need to, you need some capital so that you can go out and do it 1,000 times, let's say, or 1,000 times a year. and scale up a lot more quickly.
I want to say one thing about that. Sorry. So one of my pet peeves of product market fit is that most people treat it as binary, and it's not. It's a spectrum. So the thing is that you can have product market fit that's not perfect, but it's sellable. And then there's the other side of the spectrum where it's perfect. It's totally clicked in. And I think that you learn about that through the sales motion and through the sales cycle and through awareness and through word of mouth and all those kinds of things, right? And, it's like every industry is going to have different indicators of those things. But one of the things that I fear is that some organizations might be afraid to sell a product that's on the lower end of that spectrum. And I think that that's a mistake. I think that if you're not sure if you have product market fit, you've got 10 or 20 customers and there's some really obvious gaps and things that they wish were there, but it is solving a problem for them and people are willing to buy it. And maybe it's not the perfect sales cycle. Maybe it's a little longer than you want it to be. Well, that can be okay too, because you can adjust go-to-market strategy around that. And the way that you get to a more perfect product market fit is to sell more of it and then reinvest that in the product. I think that's an important paradigm.
No, that's a good point. Iterating, right? Iterating. Yeah. The other interesting thing too, right, is and something we kind of look at as well when we're investing in people. Product market fit may not be product market fit tomorrow. But like you were saying earlier, the market is pretty dynamic.
Right. Totally.
Yeah, it may be moving pretty quickly. So even if it's not the perfect product market fit today, you actually might be, you may be skating to where the puck's gonna be.
True, totally. And there's, and then sometimes you may not know where the puck is going to be, and then that's your job to go and figure that out. That's a major aspect of it. So if you look at the bullets of things that are on my list of things that I need to do, keeping the business capitalized is number one, but then keeping my eye on the puck and making guesses about where it's going to be is kind of the second bullet, right? So the market is changing rapidly no matter what market you're in. Yeah. And it might be changing in a million little ways, and they're very, very hard to detect, or it might be changing in some really, really big ways. And I just think that it's really hard to keep track of all these things. And I think there's a balance between, trying to figure out how to sort through the noise and create some information out of it, but also having some self-empathy and some ability to kind of be kind to yourself, because you're never going to get it right all of the time, and you're never going to get it exactly right. And if you do get it exactly right, it's probably because you put a lot of work into it, but it's probably also because you were lucky. And at that point in time, I think that's good to recognize that too.
Be self-aware. I think that's true. Be self-aware. Be thankful. Be grateful you got lucky, and that's fine.
Yeah, it's great.
In the trading world, we used to say it's better to be lucky than good.
I've always preferred it.
Yeah, it's definitely. So you started talking a little bit about your challenges. Maybe what other challenges, or what are your main challenges right now in the business facing you?
That's a great question. So the price of salespeople.
What is that?
The price of salespeople. There is a ferocious war on talent right now.
Yeah, productive, proven salespeople.
Yeah. Really, salespeople in general, the price, they've been bid up a lot. But really highly proven salespeople are another matter. Yeah. So there's a war on talent for developers. There's a war on talent for salespeople. That's probably the biggest problems that we're running into right now. I think that there's always, I guess I can't really. There's always a million little problems, right? There's something every day that you gotta handle. But I think when you kind of boil it all down, the big thing right now is just getting great people who are a great fit. Really work inside of the systems, processes, and culture of our team. and getting them enabled and like getting them out in the marketplace and all those kinds of things. So I think it's just the same problems that everybody has right now.
How are you managing with the return to work post pandemic? How are you?
Well, I'm sitting in my home office right now, so what does that tell you?
Are you going to stay? So are you guys going to stay hybrid? Do you think, or are you going to go?
We're going to stay hybrid. We were basically hybrid before the pandemic.
Yeah.
But we got to being, obviously tilted, way more towards virtual than in person. I have set a date of September 15th for myself to be back in the office, a minimum of 4 days a week.
Wow.
4 days a week.
Yeah.
I really want to have that routine back. For me, it's been personally difficult to get back into the office because I established a routine here at home, and I just haven't gone through the motions of reestablishing a different routine.
Yep.
And that's really why I'm still at home. But some people are back in the office. I'm probably back in the office once a week, and I'm working towards being back there most of the time. So I do think there's value there.
Cool. Yeah, a lot of people, ask that question, so I've figured I'd get a data point from you.
Cool.
So I wanted to leave. We've got about 5 minutes left. I didn't know if Michael, wanted to share any parting comments or wrap up.
Hey guys, sorry, it took a second to get back on the screen here.
Or if there's any other Q&A, I guess. Whatever.
I think it's been great. Yeah, if anyone has any more questions, just share them real quick. But we are going to wrap up. But if there aren't any, I would ask, if you guys wanted to share any way to, keep in touch with you guys, get, anything else you want to, you're working on or you want to share. So in wrapping up, if there's any other way, you guys, anything that you want to communicate or have anyone reach out to you.
I'll go first. So yeah, please, I spoke earlier about what our sort of criteria and desires are for making investment, but please feel free to reach out to us. If you're on the way there, we're happy to talk. I'm happy to talk to people, as you can tell, and get to know people in advance. Because like Patrick said, it's kind of a long relationship and we should get to know each other a little bit anyway before we, before I write a big check and you give up a big piece of your company. So I'm also more than happy to give advice. Like I said, we can't invest in everybody, but we really do. And I know it's become sort of a meme on Twitter, but we really do try to be helpful in places where we can't invest, especially when it comes to these tech ecosystems that we're trying to help grow, right? Because the more these ecosystems grow, the more opportunities for us and into the region. We're happy to do 1 out of 10 and then bring other people in to do the other 9 and just continue to grow this flywheel effect. So reach out to me on LinkedIn. My email address is Steve H, so that they don't have to pronounce the whole last name because like Mike had trouble with it. But Steve H at armorysv.com, and I'm happy to look at decks and talk out business plans.
Cool. So I guess I'll go. So you can find me on Twitter or LinkedIn. I'm at Patrick Bosek on Twitter. I'm /Patrick Bosek on LinkedIn, so it's pretty easy. I am always happy to talk to anybody who's in the upstate ecosystem too. If you're in Rochester, I try to grab coffee with other CEOs or startup founders or whoever, a couple times a month, whatever. I'm happy to bounce ideas around, do whatever. I also want to be supportive of the ecosystem, which I guess I probably don't have as strong a business reason as Steve does, but I think it's a good thing.
We'll do a happy hour. We'll do a little happy hour there now that we're back, and that you'll have to come meet me. That's your business purpose.
All right, we'll do that. So reach out to me. I'm always happy to chat. And I like to meet other people who are hanging out and doing cool stuff and building cool technology. And the last thing I'll say is that if you do have a high-tech startup in Rochester or upstate, I would really highly recommend talking to Armory. We couldn't have gotten to where we are without them, and I think that's really. I don't know how I could possibly overstate that. They opened a lot of doors for us, and I don't know how else to say how valuable that is. So thank you, Steve.
Yeah, we love to do
Even
it.
though you weren't there when you made the decision.
That's right. We love to do it. Michael?
Thanks, Steve. Thank you for joining today. This is great, and we'll see each other. We'll see everyone next month.
Cool.
Thanks, everyone. Have a good day.